Why would the undisputed king of Latin American e-commerce intentionally nuke its own profitability right after hitting a historic $10 billion quarterly revenue milestone? In August 2026, MercadoLibre announced earnings that fundamentally divided Wall Street. On the surface, the business looked like an absolute juggernaut. But hidden inside the report was a massive drop in margins that sent shockwaves through the market. So what is Wall Street completely misunderstanding here? Today, we're going to unpack the strategy behind that drop and see why what looks like a glaring weakness is actually the ultimate competitive defense. Here's the number that triggered the panic. In the second quarter of 2026, MercadoLibre saw its operating margin compress by a massive 550 basis points, dropping down to just 6.7%. Investors instantly flinched, sending the stock tumbling over 4% in after-hours trading. The narrative was simple, right? Growth at any cost had finally caught up with them. But when you look under the hood, the reality is far more compelling. Okay, let's dive into Section 1, the margin illusion, and explore the incredible tension playing out on this company's balance sheet right now. This slide beautifully illustrates the disconnect. We've got absolute top-line dominance directly colliding with market panic. For the very first time in its history, MercadoLibre crossed $10 billion in quarterly revenue, $10.169 billion to be exact. That is a 50% year-over-year revenue explosion in US dollars. It's massive. But Wall Street just stared at that 6.7% operating margin and completely freaked out. Here's the secret, though. This profitability decline wasn't an operational failure. It was a deliberate, highly calculated decision by management to prioritize long-term scale over short-term earnings. To truly grasp why management made that call, we need to shift to Section 2 and examine the ecosystem engine to see how this business actually generates cash. See, MercadoLibre operates what we call a dual-flywheel. It's not just an e-commerce platform. It is a deeply integrated digital ecosystem stretching across 18 countries. On the commerce side, you have the marketplace, Mercado Ads, and their massive regional logistics network, Mercado Envios, which handles over 1.8 billion items a year. That physical logistics network literally locks in the sellers. Then you flip over to the Fintech side, where you have Mercado Pago, their digital wallet and merchant acquiring arm, and Mercado Crédito. This financial side locks in the buyers. When a customer uses both the commerce and the Fintech caps, they become what management calls an ecosystemic user. And this is the magic. These integrated users generate 70% more gross merchandise volume and almost 90% more total payment volume than single-service users. It's a completely self-reinforcing engine. And that ecosystem is precisely why they are winning against incredibly fierce competition. Just look at this battlefield. Amazon is heavily promoting in Brazil, yet they only hold an 11 to 12% market share, compared to MercadoLibre's dominant 40%. Shopee absolutely dominates cheap cross-border retail, but they completely lack the domestic fulfillment and digital banking integration that MercadoLibre has spent years building. And on the banking front, Nubank is a giant, serving over 113 million clients. But Mercado Pago is now sitting comfortably in the number 2 spot with over 71 million clients, aggressively scaling its own credit cards to challenge Nubank directly. Isolated single-service rivals simply cannot replicate this frictionless, dual-sided system. So MercadoLibre is fighting a multi-front war, and they are choosing to spend heavily to do it. Let's hit Section 3 and look at the hard evidence from Q2 2026 to see where that money is actually going. Announced on August 5th, 2026, the underlying health of this business is just phenomenal. Despite the margin compression we talked about, they absolutely crushed Wall Street's expectations. Net revenue shattered the $9.8 billion consensus ceiling. And even with the heavy strategic spending, earnings per share came in at $9.19, comfortably beating the top-end consensus of $8.95. Now, this is absolutely vital because it broke a 4-quarter streak of earnings misses. The core business is generating immense cash flow. So you have to ask, why did margins compress? Because of this number right here, negative 2.5%. This is MercadoLibre's net interest margin after losses, or NIML, specifically for their credit card division. MercadoLibre issued 2.6 million new credit cards in this quarter alone, driving their total credit portfolio to $16.4 billion. Customer acquisition in the credit card space is incredibly expensive up front. Management explicitly noted that new credit card cohorts take about 12 to 18 months to reach profitability. They are willingly absorbing a negative 2.5% drag right now, betting that in a year, these millions of new users will become highly profitable, deeply entrenched ecosystemic users. It's simply a customer acquisition cost, completely disguised as a margin failure. Now, I want to pause for a second because all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems for under-the-radar names with asymmetric upside; and dividend hunters, offering durable income with the fundamentals to back it up. It also includes Portfolio Watch to monitor your portfolio and flag important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's jump into Section 4, Systemic Business Quality, and see how this strategic margin compression impacts the overall health of the business. The contrast on this scorecard is fascinating. When we look at execution, MercadoLibre gets a flawless 10 out of 10 for its track record. I mean, they have delivered 30 consecutive quarters of top-line growth above 30%. That is breathtaking consistency. Their market position sits at a powerful 9 out of 10, absolutely dominating Brazilian e-commerce and fintech acquiring. But then look at profitability, a 6 out of 10. Again, because operating and net margins are currently compressed by design. Management is intentionally sacrificing that score today to lock in future market share. Now, what's really interesting is how these qualitative factors blend together. Even with a short-term hit to profitability, the aggregate score sits at a highly robust 8.4 out of 10. This points to exceptional systemic quality and high long-term business viability, way beneath the headline noise of a single quarter. And by the way, if this kind of research-first analysis is your thing, you'll probably want to subscribe. Let's transition to Section 5, Future Price Scenarios, and translate this whole moat-building exercise into cold, hard math. What do these strategic investments mean for the stock over the next 5 years? Before we run these numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's break down the operating logic required to hit these prices. In our 60% probability base case, we assume the millions of credit cards being issued today successfully mature past that 18-month mark, flipping from a negative drag to a positive 15% margin. Revenue scales at a 22% compound annual rate to $95.1 billion in year 5. Because growth naturally normalizes at that scale, we contract the P multiple down to 35x. That still implies a target price of $5,578, which is a 23.7% annualized return. In our 20% high case, Mercado Ads captures over 15% of the regional digital ad market, pushing net margins up to 10.5% on $116 billion in revenue. With a premium 42x multiple, you're looking at over $10,000 a share. But we have to look at the 20% low case. Here, intense competitive pressure from Amazon forces commission cuts across the board, and a wave of bad consumer loans cripples the fintech side. Growth slows, margins compress to 5%, and the multiple crashes to 22x, resulting in a share price of $1,345 or negative returns. When you probability weight those 3 operational outcomes, the expected 5-year target price sits at $5,637. This reveals a highly asymmetric return profile. If management's aggressive bets on free shipping and credit acquisition actually pay off, the upside is tremendous. And remember, if you want to dig into the full model and all the detailed assumptions behind this math, you can check out the detailed research report for free at flash.stocksentinel.ai. But let's not ignore that low case. For Section 6, Risks and Final Verdict, we really need to look at the concrete realities that could actually break this investment thesis. These right here are your major thesis killers. First, credit execution. Household indebtedness in Brazil is exceptionally high right now. About 30.5% of families are already in arrears on short-term debt. If the 15 to 90-day non-performing loan ratio breaks past 7.5%, that massive $16.4 billion credit portfolio turns incredibly toxic. Second, you have macro headwinds. Sustained devaluation of the Brazilian real and the Argentine peso can severely erode MercadoLibre's US dollar earnings. And finally, a hidden balance sheet risk. The company has a $632 million provision tied to a Brazilian withholding tax dispute, plus another $622 million in possible legal losses. If they are suddenly forced to settle those disputes in cash, it could drain their liquidity right when they need it most to fund their loan book.
Wall Street looked at a 550 basis point margin drop and saw a company stumbling. But when you look at the underlying ecosystem, you realize this is a highly calculated sacrifice. They are intentionally lowering the free shipping thresholds in Brazil and issuing millions of credit cards at a short-term loss. Why? Because they are converting casual shoppers into deeply entrenched, highly profitable ecosystemic users that single-service competitors like Amazon or Nubank simply cannot pry away. So, to recap, the margin drop is a customer acquisition cost, the dual flywheel is locking out rivals, and the asymmetric upside is huge, provided they can manage the regional credit risks. The margin drop isn't a weakness, it's the moat being built in real time. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.